All right, awesome. So hello, everyone. Once again, Steve Taylor here. Thanks a lot for dropping in. Maybe you're watching this post-recorded, maybe on Facebook. We really appreciate it. But this is another version of what we like to call our market conversations, where we like to come together about once a quarter with some of our experts, our expert of the day, and kind of go through what's going on out there, what's going on out in the market, because people, how they're feeling, what they're seeing. And as always, it was a busy quarter as always. So let me start off with a quick round of introductions. Giancarlo, let's start with you.
Hey guys, it's Giancarlo here, Associate Advisor with Merited Wealth, and looking forward to talking about some of the updates in the markets because there's a lot going on.
Keith?
Yeah, so my name is Keith Parker. I'm Client Portfolio Manager for AssetMark's proprietary strategies, including Savos, Market Blend, Market Dimensions, GIS, GPS, and Eris. So covering all those strategies. In addition to that, I sit with AssetMark CIO Christian Chan, along with the portfolio management team in Concord, California. And so my job is to sit in on all those meetings so I know exactly what their thoughts are on the macroeconomic environment, the markets, the economy, and positioning in the portfolios so that they can do the important job of managing those portfolios. And I get to do fun events like this and convey those messages out to the advisors and the clients.
Awesome. So let me share my screen here, Keith, and we'll get this going and get us along our way. You guys see the screen okay?
Yes.
All right. So a lot of the big conversations this last quarter is artificial intelligence, interest rates, and unfortunately, once again, we have war, right? And this has really caused a lot of unrest, a lot of uncertainty out there. We never like seeing that, but the markets have really reacted, unfortunately, a little negatively this last quarter. And it's been pretty volatile this whole year, but really that's I'd say that's par for the course, kind of going, the last year and a half and going forward. We have to get used to that. So really what we want to, kind of go through here and share is we're going to do a quick review of the market and talk about, how those numbers, worked out. And then how do we get here? What led up to those market results that we're looking at, the state of the economy, and then really what's next. We always try to be forward looking whenever we can and to say, it's not about what's happened in the past, right? It's what's happening going forward and what we do about that. It's really the important part. And then really, how do we prepare for the road ahead? Like give you some thoughts, some ideas about what we can do investment-wise and maybe planning-wise and items like that. So, here we have our highlights of the market for this last quarter. So we have that dark blue is the last quarter and the light blue is the year to date. So it looks like, Keith, we had a lot of reversals really, in this last quarter. Unfortunately, fixed income is still, is still down, and it got us negative for the year. But talk about a little bit about these highlights.
Yeah, so we did see a big reversal. It was interesting because U.S. equity market has been led by those Magnificent Seven, as they've been calling them, and that's AI related, right? These technology companies, and this is actually very characteristics of a late stage economy and how the stocks tend to react, because you tend to have narrow leadership from those large cap growth names because they are the steady cash flow earners. And so it's kind of the safest place to be if you feel like things ahead look a little bit shaky, but we keep getting very, very strong numbers. Just last week, we got some strong retail sales. We got the strong GDP number of 4.9% annualized for the third quarter. We just got another potentially scary inflation number, and that core inflation PCE deflator today was a little bit higher than it was last month. So keeping an eye on that as well, because that influences the Fed. So bringing that all together, generally negative for U.S. equities. In addition to that, you mentioned war as well. So having the conflict between Hamas and Israel obviously heartbreaking, number one, and horrific in what we're hearing out of there. And so setting the humanitarian issues aside, just thinking about the markets, that's also negative because it raises anxiety about whether this is going to broaden out into the region and have bigger market impacts than it already has. But for the most part, it looks like it's contained. We'll talk more about that later, but that was a negative on the market as well. You saw that hit international markets as well. Looking at US high yield, it still was negative on price, but because of that yield cushion that they have, that higher yield kind of saved investors and provided a little bit of cushion, even though the prices were still negative there. Emerging markets hit by the same issues, uncertainty, broadly uncertainty in the market and geopolitical issues. Fixed income is an interesting story because now we're looking at, remember, it was just slightly down. If we're talking about the Bloomberg US aggregate bond index, it was slightly negative in 2021, hugely negative in 2022, because we were coming off those very low yields and pushing those prices higher. So they didn't have that yield cushion, as I talked about with high yield. When those prices went higher, they felt the full, all investors felt the full impact because they didn't have that yield cushion. And now we're looking at negative year-to-date returns for the ag. And if you go back through the history of the ag, it's never had 3 negative years. So number one, we set, kind of a low point with a hugely negative year last year, coming off those very low interest rates. Now we're looking at potentially 3 consecutive bad years. But as you pointed out, Steve, at the beginning of the call, we're always looking ahead, not backwards. And so actually, fixed income investors are much better positioned now than they have been at any point in the past 3 years, probably even longer than that. Moving to commodities, that flight to quality sent the dollar higher, gold lower. And that was really the main driver of what you're seeing there in the broad commodity complex. But also there was a little bit of fear of contagion in the region with the Israeli-Hamas conflict. And so oil prices went higher. So there was a little bit of back and forth there, but you're seeing some anxiety in the oil pushing prices a little higher, potentially having some constrained supply if there's a broader regional conflict. But gold went lower because it tends to be, in the short term at least, kind of an offset for the dollar. Given that the dollar rallied and there was flight to quality, there was a little bit of pressure came out of gold.
Yeah, it's been real painful. Unfortunately, third year in a row, as you pointed out there, on fixed income. I mean, we made an adjustment in a lot of our portfolios to a little more of a tilt towards fixed income and short-term fixed income, which was, we would hope would de-risk the portfolio, and it does. It lowers the risk. But yeah, we had another, negative, year to date. It's been a challenge. And so we're just kind of waiting for those. And we're talking a lot to our clients that we're kind of to get over that peak, to kind of turn those over to where we stop. Hopefully the Fed slows down. We stop having those interest rate hikes. We can start enjoying some of these higher interest rates on those bonds. And that will help out the portfolios a lot.
Yeah, absolutely.
Yeah. So
the nice thing about being positioned, the nice thing about being positioned shorter in duration is that where we've seen a lot of the movement has been the intermediate and longer area of the curve. And given that duration, the price moves are magnified, right? So being that short, it is protecting investors to be short, and there are positive returns for the short-term investors, particularly treasuries, high quality. But once you get out there into the full curve, like the US aggregate bond index, that's where you see the negative.
Yeah. And then here, this has been talked about a lot. We don't need to go into it too much. The leadership in the market is really in these 7 companies, as it has been for a while. And so we'll see how that works out going forward. So, kind of a big question is like, how did we get here? So, this started, walk us through this a little, Keith, where we're talking about, the jobs and the economic flow. That we had a lot of jobs lost in the past few years, which kind of started this cycle.
Yeah, it's quickly fading, I think, from our collective memory, but that COVID shutdown was very, very scary. Remember, a lot of the conversation at that time with the pandemic was that it might take up to 5 years to get a vaccine, and that there was going to be a tremendous number of deaths and so forth. And so when we look at this, just for comparison with the global financial crisis, which everyone remembers was very painful as well, you saw 8.7 million job losses. Well, the pandemic, for comparison, was over 21 million job losses. And so the government looked at the number of job losses here and projected out that 5-year potential pandemic of death and of lower economic activity. People were traveling less, right, because of Number one, because of restrictions, and number two, because of fear of infection, both of those things kind of double impacting. And so the government freaked out. And so what they did was they overreacted in a way that we can see now in the hindsight of 2020 hindsight, we can see perfectly well that they overreacted. But at the time, it seemed perfectly reasonable because we were looking at a very, very dark period. And so if you move a slide forward, Steve, we can talk a little bit about the fiscal stimulus. So here we see all the different stimulus packages that went into place. And at the same time, everyone was kind of locked down in their homes. So you couldn't spend it on travel and restaurants, and nobody, very few people were actually traveling, going to restaurants and finding a way to spend this money. So they found another outlet for spending their money. If you move to the next page. And so some of these were not so bad. Oh, sorry. And then also in addition to that, you had additional buying from the Federal Reserve, which you can see here, they expanded their balance sheet, and that helped force interest rates lower. So when the Fed enters with all this money, comes in and buys bonds, they're pushing the yields higher, the prices higher, yields lower, and that made it more easy on the borrowers in the economy. So a lot of people refinanced. I refinanced right at the low and got 2.65 on a 10-year fixed rate. And a lot of people did that. And we see the reverberations going through the housing market now. But this is also another step that was taken to make sure that people were not stressed in their finances by pushing those yields lower, which pushed credit card yields lower, and those mortgages yields lower, and auto loans yields lower. And so all of those made it easier on consumers to spend money. So that takes us to the next slide about where they decided to spend their money. Yeah, those big jumps right there.
Yeah. Well, they did save. A lot of people did save. I think that was interesting. They were saying as we're getting through the last few years, right? It wasn't all spent. There was a lot of savings.
Yeah, it was a combination, right? So we saw this big buildup of savings. Some people just packed it away and put it in their savings account. Other people invested it. Other people wasted the money in some ways. And so we'll talk a little bit more about that. But that's been one of the drivers about this strong economy, even as the Fed has raised 525 basis points in the span of less than 2 years, which is almost unprecedented. We've had a few times when the Fed has raised interest rates this quickly or close to this fast, but this has really been unprecedented coming off that pretty much zero interest rate heading into this period. So that would normally really constrain the consumer, but because we're coming off such lows when, as I mentioned, everybody was able to refinance, everyone's just sitting on those low interest loans and they saved all this money in the bank. And so that's part of what's propelling this higher than expected, stronger than expected consumer.
You think it's just been basically that money that was in the bank, it's being spent. So that's when we get that GDP number that comes in today, beating what was expected. You think it's just it's coming from savings, not kind of new production or current income. They're just converting those savings into spending.
That's a big driver. And then also you've seen a little bit higher numbers coming out of the raises from the wages. Mm-hmm. So when you see the wage increases as well, those have been pretty substantial. So that's also driving some of the spending. And then you're also seeing credit cards. After credit cards, when these payments first went out to consumers, they did pay down their credit cards. So there was this big dip down in credit card payments, and now they've rebounded. I think there's a slide on that later. But in addition to that, as they went out and did all this spending, so the price change, this is 2020, 2021, gasoline went higher, pork prices went higher. The NASDAQ 100 people invested the money in the NASDAQ, so that pushed prices higher in the index, and so kind of front run some of the future earnings that you were going to see from some of those companies. And so we saw some of that pull back in 2022, of course, the next year after this. And then in high yield bonds, it was another place that people invested some of that money.
Yeah. So that's a good summary of showing us how we got here, what happened. It's always good to start with a reminder of what's happened, right? People, their perspectives sometimes remain very short term, right? So we forgot, how we got there, but that's what happened. A lot of money came into the economy. Inflation, of course, is going to follow. There was some good parts on the spending. I'm sorry, on the savings, and now it's kind of it's changed. It's kind of reverberating. So it's interesting. What I've always found interesting throughout this whole process, Keith, is that, during the pandemic, the positions really, became very hard to find people, whether they wanted to work or not, whatever they were, to get that good quality, those good quality employees, was hard to find. But then as we've gone through this, the Fed has gone, like you said, in this tightening cycle and gone through it. Employment has stayed, and unemployment has stayed very low, and employment stayed very high. And a lot of indicators, that's a positive indicator, right? Out there that people are working, there's jobs to be had, but it feels like, the Fed's not going to slow down almost until employment unemployment starts to spike up a little. So what's your thoughts on that? And what is this employment, these jobs showing us?
Yeah, you can see that dramatic drop off during the period of the pandemic. And so during that time, the services sector pretty much died, right? So there were people that actually left the services sector and said, I'm not going to work in a restaurant anymore. Maybe it wasn't such a great job in the first place, and now they can't find any work. So they said, I don't know, I'm going to be a Lyft driver. I'm going to work from home as an office worker, whatever they made that transition. Then when the service sector recovered, when we got vaccines, when people felt comfortable traveling again, when all those restrictions on travel were lifted, all of a sudden everybody had that pent up demand where they weren't allowed to travel or didn't feel safe traveling. All of a sudden they could travel, and it just rebounded crazy. And because of that, all these service sector employees, from airline pilots to flight attendants to movie theater people and workers to restaurant workers and bar workers, all these people, some of them were no longer to be found, right? They transitioned into other careers, and then others had retired. There was a big retirement push because people didn't feel safe if they were older, because obviously the pandemic hit older people more. So if you were over the age of 55, maybe you just decided, well, I have enough, I can just retire. Over the age of 60, they just retired. And that just accelerated, what we see long-term happening with the baby boomers, and that they're retiring at 10 million per day. And so because of that, that's a lot of workers to replace on a regular basis. So as we tried to build that back up, you've seen that unemployment rate come down to what's currently 3.8%, which is considered full employment. And you think about the Federal Reserve and their dual mandate. Their dual mandate is to full employment and then also stable prices. And so given that we're at full employment, they don't need to worry about the employment picture at this time. So they're willing to sacrifice, if you want to call it that, some of the stability in the full employment workforce to stabilize prices, because prices have been so high. So remember, we peaked at 9.1% last year. It's been trending lower, but we're still at 3.9%. They want to get to 2%. The easy transition has already happened. Some of the lockup in the supply has freed up, and so the supply is coming back online. And so because of that, some of that inflation has come down. The Fed has pumped the brakes a little bit by raising interest rates, but it hasn't really flown through the economy because there's these long and variable lags with the Federal Reserve, as they call it, where as they raise interest rates, the liquid markets react immediately. Stocks, bonds, cash, they will react to the changes from the Federal Reserve. But it takes a while for those Federal Reserve interest rate hikes to feed through the system. And that's why the Fed has chosen to pause right now, to wait for those to kind of feed through the system. And for people like us that, those of us that refinanced at the lows, we're still waiting to see when we refinance again, or when we move to have those higher interest rates impact our spending levels. So coming back to employment, we're at full employment. The strength is very strong in the employment picture. And so I think the Federal Reserve is looking for this to edge a little bit higher, because what you want to avoid is the wage price spiral. And so when you see above average earnings growth in the employment sector, that means you can pay more for the goods, and that propels inflation higher. So that's why they're willing to push up from the 3.8% up above 4%. Maybe you might even see 5% interest rate in 2024, unemployment rate in 2024, because that's going to bring that inflation, the wage price spiral down.
Yeah, that's unfortunate, right? We almost have to get those bad news for this, for the hiking to feel confident that it's going to stop. But that's kind of how it works. So this is, it's interesting where you said a couple times, right, about how at the peak, I was lucky, just like you. I started the process right before COVID started. interest rates were so low, right? And we all locked in there. And there's a lot of people are saying, the real estate market seems to be softening a little. Homes are staying on the market a little bit longer, right? But prices are still kind of sticking there. And they're thinking as interest rates, traditionally when they rise, that the home prices, real estate prices come down because they're inverted and you can afford less home. But a lot of people are sitting on these really low interest rate loans, right? So there's not, as long as they can sit on those loans, this high interest rates really doesn't affect them, right? And it's kind of keeping the supply low and those home prices really, up there. It does feel though that we are getting, a little reduction in home price increases.
Yeah, and this is just a moderation, right? This is kind of a consolidation after an amazing period for home price inflation, going up 15%. That's a really substantial increase, right? So now we're getting a little bit closer to zero, we'll call it. And so part of that is driven by the existing supply. As you mentioned, if you're already sitting on a home with a low interest rate, that's propelling some of the spending too, because if you refinance a low interest rate, you've got a little bit more flexibility because the mortgage is typically one consumer's one of their highest bills, right? One of their highest commitments. And so because of that, they're able to spend a little bit more. And now when we see the home price increases moderating, that's the first sign that we see a little bit of that air being taken out of the economy and some of those inflation, some of the interest rate hikes from the Federal Reserve flowing through to the economy and taking some of the air out of that.
Yeah, and it's even though my primary mortgage is really, really low, I always like having a line of credit open on my house, and that's no bueno at all. I mean, that's
Yes.
crazy. I'm seeing numbers on that. I tell people that since I've only been a homeowner, I guess a little around 20 plus years, and we haven't seen interest rates like that. So it's really it's really crazy out there what's happening. And so the energy inflation, that's been an interesting story, right? You said this last quarter, energy commodities ticked up a little, but that was one of the biggest areas that really came down over this last year as the Fed was targeting the inflation. And it seems, that prices, though, I guess looks like they're going to potentially stay fairly high, right? As inventory is low.
That's right. Yeah. So low inventory means that they got to build that inventory back up. So that's going to put some upward pressure on prices, but we've never had greater production from the United States. We're putting out 13 million barrels per day in production out of the United States. That's the greatest production that we've ever had. So we're basically self-sufficient. What's interesting about what we get from Texas and Oklahoma is that we get the highest quality oil. And by that, I mean, they call it light sweet crude. And so because of that, light means that there's less particles in there. It's a less thick liquid. And so because of that, the oil is easier to process. And then sweet refers to the amount of sulfur. And sulfur also makes it difficult to process. Now, the difficulty is this. All of our processing plants, all of our oil processing plants are designed for heavy, less, I don't know what the less sweet crude, the imported oil, essentially, the less effective oil that we produce in this country, we can't process it. So we actually export oil that's higher quality to other processes that are more modern and that are adapted for this higher quality oil. And we import from countries, other countries like Saudi Arabia, for instance, where they have lower quality oil because that's what our processing plants will use. So it's kind of an interesting conundrum in that we produce enough oil to take care of all of our needs in the United States, but we have to export it because we don't have the proper oil processing plants.
That's amazing. Yeah, that's amazing. Things like those are out there. I think last time, we might have spoken as well. We're talking about the rise of the EVs, right? The electric vehicles, and my family, we took advantage of the tax credit this year. My wife got a Tesla. I got a hybrid in there. But I don't know if you're reading or you're seeing out there that there's a lot of the car makers are, the cost of these EVs, they're really pushing back on them. So they're really wondering about the overall adoption, the big adoption that it might not be, the demand may not be as high as they truly thought. So that'll be interesting, that interplay between that and the oil need.
Yeah, I think the transition will take a little bit longer. By all indications, the transition will take a little bit longer than they were hoping. I think they were expecting kind of an explosion in growth, and it's less substantial than they were thinking when they started committing to all this the EV vehicles.
Yeah, yeah, and the charging infrastructure is just, it's, they talk about it a lot. It's not there. In fact, I went to my local grocery store and I pulled into a space with a charger there, and if it works, it does not look like it works at all. I mean, they're not being maintained, they're not being looked after. So there's a long way to go before they really, it's going to make that meaningful seismic shift that everyone's anticipating. And I guess this slide talks to us a little bit about what you brought up earlier. What it's looking like is a lot of the strength out there may just be that, people are taking money out of their savings and spending it.
Yeah, and so you can see, especially when you break it out by, the household incomes, those in the lowest 40% of household incomes have easily burned through what the stimulus that was provided during the pandemic.
Mm-hmm.
And then you even look at the 40 to 80% income households, and those have also burned through essentially all of it at this point. And when you get to above 80% income thresholds, those are areas where they don't need to spend all of their money, right? These may continue to be savings going forward. They may just continue to hold that in the bank. So we're not certain whether to what extent that's ever going to drain off. So really, as we look at the depleted household savings from that pandemic relief, we're looking at something that's fading away. And what we're also looking at, and I think we'll show going forward, is that credit card usage is going back up and getting back up, not only up to trend, but back above trend. So these are just some things that we see, despite the fact that the economy is strong now, as I mentioned, with the retail sales last week, the GDP this week, and so the economic growth being strong. We're coming from a position of strength, but we're looking ahead. As you said, you always want to look ahead. And so we're seeing some softer economic numbers likely coming forward as the consumers moderate their spending back down to levels that are a little bit, that don't have to drain the savings or pump up the credit cards.
Yeah, that's not the American way. And so I just want to put a mention out there for any attendees out there. If you have any questions, please just post in the chat. Let us know if you'd like any, us to address anything, any questions you might have. Please never hesitate to put that out there. So this is a really interesting, this has always been a very interesting dynamic, right? This is something I'm pretty passionate about. I've done a couple of my podcasts and I talk about young people. I was just talking about with my trainer this morning at the gym. She's this nice young lady. She's taking her first student loan for her master's. And so really talking about the necessity and really understanding what can you borrow for your education, right? Or what's a good return on investment on that. But a big thing throughout the whole pandemic was the student loans were paused, and it kind of never got depaused. But now these are starting back up again. And it looks like a dramatic uptick. So I'm sure that's putting a lot of strain on those those younger in the workforce, taking a bigger bite out of their paycheck.
Yeah, and some of this, the giant spike up, some of this is voluntary prepayments of student loans. People were able to, again, they might have that savings and they might be using that savings to just say, I don't want to have that student payment anymore. But it is undoubtedly another headwind to consumer spending going forward. Because if you didn't have to make that $200 a month payment or $300 a month payment to your student loan during this time period, that's pumped up that consumer spending or moved some of that consumer spending forward. Now, as that bill comes back due again, and you have to make that monthly payment, that's $200, $300 a month less that you can spend each month that you were spending before. So this is just another headwind to consumer spending as we head into the end of 2023 and into the calendar year 2024.
Yeah. And anyone listening out there, if you have student loans, and are a lot of programs out there, if you have these federal loans, and to make that payback a little more affordable. So there's a lot of strategies, a lot of research you can do in there. Don't just, if it's a stress on you, look to it, look at those rules, reach out to those that know to kind of find out a good strategy for you to get those paid back. So, companies, it seems like last quarter, there was a slide when we were doing the presentation, working through with clients, it seemed like that, yes, the personal consumer savings was higher, but now, as we're showing, it's getting a little stretched. And it said that the companies, their interest coverage ratio was higher, not too far back, right? But now it seems like that's getting stretched a little also. I guess companies are being forced to use their cash as well.
Yeah, this is just another thing that we keep an eye on. This is the health of a company. When you're looking for a company with a strong balance sheet, this is one of those ratios that you look at where what is their interest coverage ratio? So in other words, what is the amount of interest versus the amount of cash in the bank? So in other words, to finance or to make those payments. And so when you look back, we were in a really good shape just going back into early 2022. But remember, that's exactly when the Fed started hiking interest rates, right? So some of the interest is going to be paid on floating rate debt.
Mhm.
And so as those floating rate interest rates went higher with the Federal Reserve's interest rate hikes, you're seeing some of that cash get drained out of there. And so that interest coverage ratio is going down. In addition to that, those corporate bonds that get repaid have to be refinanced at a higher interest rate now, right? The interest rates are now higher, at least when you go up to 5-10 years, than they have been since pre-financial crisis. So we're talking about, 15 years of lower interest rates, and now we're going back up into what I would consider a normal interest rate environment. I would say the last 15 years have been abnormally low relative to all the time periods prior to that. So we're getting back into a normal interest rate where it actually costs money in terms of interest rate payments to borrow money. And so you're seeing that affect the balance sheets. And so as we get down, remember, it's good is on the top, bad is on the bottom. It's kind of somewhere in between. So we're not necessarily worried about the level right now, but we're looking at that trend and forecasting that forward and saying, companies may need to start tightening their belts coming 2024 and have less spending from the company side as well from the firms.
Yeah, everyone got lulled into the short, the low interest rates for so long, and they didn't worry when it rolled over. They want to stay flexible, not locking in kind of a long-term or lower interest rate because think, hey, this is gonna last forever. This is great, right? So they kept that flexibility, and so it's been caught. It looks like it's caught the companies off guard. The interest rates, the lower interest rates, staying for longer, sure as heck caught the banks off guard earlier this year. And even it seems like we're starting to see a little spike in corporate bankruptcies as well.
Yeah, and you can see this isn't like a panic level, right? So we're not seeing, if you look back at August 2008, there on the left hand side of this graph, or kind of in the middle of the slide, you can see that was that huge spike up, during that time period of the financial crisis. And then you can see during the pandemic, there was also another spike way higher. When you see that dotted yellow line, by the way, that dots all the way back to 2001. So we're talking about a time period that's a little bit more comparable to what we're thinking we're in now. If you think back to 2000, that was when the dot-com bubble burst and we got kind of a shallow recession in 2000, 2001, and it seemed kind of sluggish coming out through 2002, 2003. I think it probably won't even our forecast is really with the strength of the consumer. It probably will not even be as severe as that. But when you look at the bankruptcies, you can see that the level is closer on par to 2001 than it is, of course, during the more stressed time periods of the financial crisis and the pandemic. So we're just trying to show that this may be more of a garden variety recession that we're heading into if we get the recession. Now, there is an increasing chance that the Fed achieves its goal of a soft landing. A lot of people are already kind of in that camp. We're not in that camp, but we do see the increased risk. And so this is just another thing where when you see those corporate bankruptcies go up, you're thinking, well, it's a little bit less likely that they're going to get that soft landing, and you're probably going to get at least a shallow recession, but it won't be anything like what we experienced. It doesn't look to have all the characteristics of the financial crisis or the pandemic.
Yeah, no, appreciate that. Appreciate all these different aspects of looking at it because it's not just one factor, right? A lot of people will get too concerned to hear one headline about everything, but there's so many factors involved here, and it's important to really to take that into account. And so the size of the Fed balance sheet, as you were saying, to keep interest rates low during the pandemic, they bought up, put a little more, a lot of T-bills on their balance sheet, but now they're easing, they're selling those, a little bit. How's that affecting this? What is your guys' outlook and thoughts about that? The size of the Fed's balance sheet here, Keith?
Yeah, so this is just another thing they did during the pandemic. As we saw, they bought intermediate and longer term bonds to push those prices higher, yields lower, and those went onto the Federal Reserve's balance sheet. They essentially pulled that supply out of the market. Now they're pushing that supply back into the market, reducing their balance sheet, and in doing so, that pushes the prices lower, yield as they're selling, right? There's more supply on the market, and you see a little bit of upward pressure on the interest rates. We're seeing that in the intermediate area of the curve and longer area of the curve, and that's what we already talked about earlier when we got on the first slide when we talked about performance with the Bloomberg US Aggregate Bond Index being negative year to date. So we're seeing pressure all the way across the curve, particularly though it seems like most of the pain recently have been the intermediate and longer areas. Some of that pressure is coming from the Fed as well. So as they unload all that buying, you can see that steep increase in buying in September 2020 or in 2020 when they started buying up some of that the supply on the market, and now they're going to slowly start feeding that back in the market. And that's going to again keep that upward pressure on intermediate and longer interest rates.
Yeah. So here's another, a lot of the discussion as they talk about stimulus, but stimulus comes in more ways than just cash payments. I mean, there's been a lot of government spending out there, and it seems that that's contributing a lot to the support of the economy as well.
Yes. And so the CHIPS Act, again, that's just another way of providing tax breaks to incentivize companies to onshore their processes. So we already figured out that, one of the issues that was brought to light when Russia invaded Ukraine was that all these deals that we had with Russia, in order to isolate them economically and show them that it's not okay to invade any other bordering nation, no matter what your feelings are about them, that, there are certain rules, standards with the international community. So as they walled off Russia and really did their best to isolate them economically, we also realized that it was in our best interest to make sure that we had some processes in place to do our own manufacturing here, because people started to project, well, China's been talking pretty tough about Taiwan as well. What if they were to move? Well, China is the producer of the world, right? So that's where all of our chips are coming from. So it made people rethink, and particularly the US, but also all Western economies, if we do need to economically isolate a country to enforce the standards that we expect from the international community, then we need to incentivize our companies to produce in our countries, or at least friendly countries. And so with the CHIPS Act, there's a tax incentive to produce those chips here in the United States rather than doing it overseas, where it's typically been a lower cost. And so we're trying to make that lower cost for those companies to onshore that production of chips by producing tax breaks. And so that's going to have, by the way, upward pressure on prices too, right? We've been in this deflationary period where we've been offshoring to the lowest cost producer in the world. Piece. Well, now we're starting to see all these geopolitical flare-ups, and we're realizing that's not necessarily the safest place to be. So that's what this is designed to do. But this just adds more government spending as you reduce taxes, which reduces revenue to the government, as spending remains the same or typically increases, right? They rarely find a way to decrease spending in DC, but they do find ways to reduce taxes. So they're reducing the income to the government, and they're increasing the spending, which blows out the deficit spending.
Yeah. So now we get to the next, so that's we've kind of gone through and say how we got here. We see where we're at. Now preparing for the road ahead, right? What are some ideas and thoughts, for, that we're thinking about for our clients' portfolios, that maybe those out there should be thinking out there for their own portfolios? Like, how does this all boil down to, and how is this affecting, how should this infect your investment portfolios? So, a lot of people, a lot of conversations are coming, and the banks are pushing it, right? That they have their CDs out there, right? We lock you in for 24, 36 months. We'll give you 5% or whatever it might be. So, in this slide here, Keith, you guys are pointing out that the opportunity cost of investing in CDs, it might be too high, right? To be able to use that money for other items.
Yeah, one thing to keep in mind as we think about a slowing economy is that interest rates will stabilize. So the way that we look at it is When you see upward pressure on inflation, that's going to push those interest rates higher to compensate investors for that higher expected inflation. If we get into the reverse, where we kind of get into a slower economic environment and those inflation expectations and the actual inflation comes down, the real inflation comes down, you're going to be in a period where interest rates start to moderate and move lower. And that means prices are moving higher on bonds. Well, guess what? Your bank account is fixed. Both your bank account, the CDs, the savings accounts, and the money market funds are all at a fixed principal. So given that you're at a fixed principal, the only thing you have at that point is your interest rate. And if your interest rate stays the same or goes down, then you're going to be in a less advantageous place than if you were in a bond where your interest rate is going down, but your price is going up, right? So that's where you get paid to have a little bit of fluctuation in your price. Now, short-term bonds are not going to do anything dramatic, but even short-term bonds will go higher if the Federal Reserve gets to a point where, as we talked about, maybe that unemployment rate going above 4% or going above 5%. At the point where the Federal Reserve says, oh, we need to add a little bit more fuel to stabilize the economy, and they start lowering interest rates, that's a point where interest rates are going lower and prices are going higher. And so you have that strength built into here, and that's the opportunity cost of CDs at this point, is that your principal is fixed and you'll be subject to that lower interest rate, but you won't get the benefit of having your principal increase.
Yeah, it's interesting. I'm looking at this chart here, and it's talking about showing some of the different fixed income investments and how they've done in other maybe slow down, potentially recessionary times. Yeah. And one of the leading ones there is investment grade credit. There's a lot of discussion about those bonds. For the point you say, their yields are going up, and if interest rates plateau and roll over, you get some price increase. What's interesting, what we're hearing a lot of conversation about, different analysts out there or market commentators, investment commentators are talking about high yield credit, and that high yield is kind of poised in a pretty good spot, that because the yields are so high right now, it's looking like that high yield is a good place to be, maybe, primarily as an alternative for equities, right? Because they move in a similar position. But there's a lot of people, talking out there that high yield credit over the long term, and in this period longer for higher, might be a good spot, right? And that the volatility may not be as bad. What is AssetMark's thought, about the high yield credit space?
Yeah, so it's a time of caution. You always want to be cautious about high yield when you're heading into an economic slowdown, just because that's typically when those bankruptcies start to come up. And if you're talking about a BB or a lower rated bond, that means there is a risk of bankruptcy there, especially once you get down below a single B into the triple C's and lower. You've got some real risks there, right? So what you don't want to do is have a very narrow exposure there. To the extent that you can diversify. The Savos High Yield Bond Fund diversifies across thousands of individual bonds, and that's how we avoid that the risk of a single bankruptcy or a handful of bankruptcies kind of affecting a client by having that broad exposure. So I would just say, if you're an income-oriented investor and you're willing to have some fluctuation of principal, which is what's going to happen with high yield, it always does, then the yields are looking attractive, especially once you look out beyond 1, 2, 3 years. Once you get out past that area where we look for volatility going forward into 2024. But once you get past that, these yields are probably going to pay off pretty good. Yeah. So it's not a bad place to be for that income-oriented investor that doesn't mind watching the principal fluctuate. If you're a conservative investor, I would really advise caution, and probably it wouldn't be a great place to be, because what we don't want to do is have a cautious investor get into high yield and then have some volatility and sell at the wrong time when the price is down.
Yeah, that's interesting. You point out that, it's great as always to be diversified, but I think historically high yields, depending maybe a 2 to 4% failure, percentage in that space with those bonds. But if you're diversified, such a strong yield as we have right now could easily come over that. Yeah, we're thinking about that for even younger investors also, just in a total return portfolio, to have stock-like return, not being in stock. So it's an interesting space there of what's happening, especially with all these high interest rates and all this yield, for something that we've not seen for so many years. So a lot of different conversations. Yeah. So this is I guess just talking a little bit about, if we do have a recession, typically what the market has looked pre and post recession.
Yeah. Yeah, and so just looking at the performance when the typically what you see is that you don't know you're in a recession, and the recession will be announced late into what you're already in the recession by the time they announce it as being a recession. So again, we don't see that as being the current time period, because if you look back, we saw again the retail sales last week, the GDP this week, all of the numbers look strong in the current environment, but we are seeing that trend lower in stock prices. Currently over the last few months. If that continues, stocks have been shown to be kind of a leader in indicating a potential slowdown, economic slowdown, or a potential recession. So we're still trying to figure out whether it's just a slowdown or whether there's perhaps a shallow recession coming. But there's currently strength. But during what this slide is pointing out is that you don't always hear like, oh, we're now entering the recession. The time period doesn't work out like that. By the time they figure out it's a recession, you're in it. And by the time they announce you're out of it, you've been out of it for a while. So you don't really want to wait for those announcements necessarily. What you really want to do is stay in line with your long-term strategic goals. And at those points where you're feeling anxious, you can tilt in the direction of quality or tilt in the direction of decreasing some of your exposure to the market. But what you don't want to do is really try to time recessions. It's been shown to not really help, because you're going to be late, as this slide shows.
Yeah, that's always the case, and we can never time it. And it talks here that the U.S. equities during the past recessions, I guess it's not even during. We're coming up to the recession, like right in this normal economic flow. When you're getting to, you're going through the cycle, you're coming up to a recession, you've already started your downturn. Typically the market leads, right? The market leads. And as you mentioned, the economy comes after that. But in these recessions, equity returns could actually be pretty strong.
Yeah, there have been time periods where we've seen strong returns from the stock market. So it depends on how quickly and how strong the recovery happens. So as I mentioned in 2002, as an example, there was kind of a sluggish recovery that happened. And if you remember in 2008, with all the government stimulus to try to stabilize the economy, we actually came out of that one fairly quickly. And there was this anticipation as the stock market looked forward and said, look at all these programs with the Fed, buying bonds and pushing those interest rates lower and lowering interest rates to zero. They looked forward and said, this is going to be a very advantageous time for companies to stabilize and be profitable going forward. So you can see that one is the top middle in 2008 with the 40% return off the bottom in the recovery. And you see the 02, where we had more of a sluggish recovery, negative 15% over on the right-hand side on the top. So these can kind of contrast, but just understand that just because we're entering recession or going into recession doesn't mean it's the end of the world, because the stock market is always looking forward, as we already talked about. So it's partly what's happening now, but they take what's happening now and forecast in the future based upon what they see coming from the companies and what they see coming from the CHIPS Act, which is stimulative for the economy. And all these different things get calculated into those forward stock prices.
Yeah, that's great. Great perspective. So I think here, this is really what we're talking about a lot. We talk with our clients all the time. We talk about the importance of diversification, the importance of time. It's time, not timing. You're mentioning trying to time coming out of the recession, what it might be. It's all about time and not timing is really the important part of when you're managing a portfolio for the long term in it. And, a lot of what we do, as we go through, we rebalance for our clients, right? Because as our portfolios, we start our allocations, we have some winners and losers, and it's a great way to rebalance back to where your allocation should be. You automatically sell the winner, take some of your winnings and invest in some of your losings. It's a great strategy to go there. And it's just, it's important to understand, these slides and items about that staying invested, staying diversified, because it works out over the long term. So Keith, as we wrap up here and we go some key takeaways, I guess we'll walk through and tell us, it's interesting that Fed, they always had that target at 2%. And I hear you said not only is it going to be hard, I hear different commentators say it may not get there, right? And that, new normals is a term people like to use, maybe 3%, where we can get to 2.5%. And maybe that's okay. Maybe production will keep up, but it's looking like that's going to be hard.
Yeah, and we talked about there are some warning signs on the horizon, but generally the consumer is strong in the current environment. Generally, corporate balance sheets are strong, and then in addition to that, you have the CHIPS Act. You have this onshoring of we have been in this downtrend for over in excess of 20 years, since 2000 all the way to 2001 or 2021, where you had everybody offshoring to the lowest cost producer. Now we're having a onshoring where people are bringing back to shore up all those supply chain disruptions that happened during COVID and as a result of the geopolitical issues. And so those all have, as they bring these back, we are not the lowest cost producer in the United States. We have a higher labor cost, higher costs for the regulatory environment, higher costs for typically the land that you're producing. So these are going to have upward pressure on the producer prices, which are going to flow through to the consumer. So these are going to be things that feed through into that core inflation getting back down to 2%, even though we're at 3.9% now and we were at 9.1. That was the easy part, believe it or not. The hard part is going to be going from 3.9 to 2% because we think it's going to be sticky here. So be ready for this to last a little bit longer than you think. And this is why the Fed keeps talking about higher for longer. And now after the core PCE inflation today and the strong retail sales and GDP, as I mentioned a couple of times, these may have the Fed thinking about another 25 basis point hike or maybe two more 25 basis point hikes to get us back to that 2% because they are fixated on that. So keep an eye out for that may be an issue going into 2024.
Yeah. You know, when you say that, and we've got through the easy part, what it makes me think of is, especially in light, you know, there's a lot of late weight loss out there nowadays, right? With Ozempic and all these miracle drugs. And anyone that's gone through a period of weight loss, they're starting to, you start to exercise, you start to eat better, and lo and behold, the pounds just fly off, right? They go away immediately. But then once you start getting past those initial pounds to really get to maybe where your target weight is, where you're trying to go, it's much harder. You have to keep working out. You have to keep, eating right. And so I think for a lot of people out there, as we're going through this, it's a long road, right? And we say, okay, things are looking better. You know, if you've changed your spending, you've changed, your different habits and stuff like that, stick to it. Any of those strategies you've been implementing, keep them there, right? And be patient with it. And it really goes from kind of a fad, like that initial, taking that weight loss drug to, hey, this is a way of life, right? This is a way of life. I can maintain this, right? This isn't the end of the world. So, if you do that and you're living within your budget, within your means, right? You've tightened your belt or whatever it might be, what's going on with the economy, what's out there, right? You're going to be okay. You're going to weather it just fine, because really that's where you should focus on your spending and your budgeting, and not really, you honestly shouldn't be focusing that much on what the market's doing, right? Hopefully you've developed a plan. Your distributions are according to your expectations, and risk has been properly allocated. But that's really, the biggest thing I think to stick by. Well, Keith, man, I really, really appreciate, all this time that you give for us. I hope the people that attended or people that watch this later on found this helpful. If anybody's seeing this, you have any questions, any follow-up, just let us know. We'll reach out to Keith. We're happy to talk to you about any questions or items you might have. But, so thank you. So thanks a lot, Keith.
Yeah, Steve, it's always a pleasure. Thank you for having me on.